It makes the drug that could end obesity, and the market has already priced it like a guaranteed miracle. This is Eli Lilly. So here is the coldest read there is. The methods, the money, the crowd, you be the judge.
One company built a drug that makes people lose nearly 30% of their body weight. It works better than surgery. It has not been approved yet. And in June 2026, the market decided it is worth nearly $1 trillion anyway. 5 of history's greatest investors are about to tell you exactly what they think of that price. For 60 years, every obesity drug either did not work or killed people. Tirzepatide changed that. It targets 2 hormones simultaneously, producing weight loss that clinical medicine had never seen from a pill or injection. Lilly did not just build a product, it built a platform, and the platform is expanding. Eli Lilly generated $45 billion in revenue in 2024. That is a 32% increase from the year before. For a company this size, that growth rate is extraordinary. The engine behind it, Mounjaro and Zepbound, the 2 commercial forms of tirzepatide, generated more than $16 billion combined in their first full year. At 81.3% gross margin, Lilly is not a manufacturer, it is a pricing machine. The research and development line runs nearly $11 billion per year, 24% of revenue. That is the cost of the pipeline. The margin is the product of the platform. Retatrutide, triple mechanism, targets 3 hormones at once. In phase 3 trials, participants lost an average of 28.3% of their body weight over 80 weeks. Nearly 1 in 2 participants lost more than 30%. That is not a diet drug, that is a metabolic reset. The filing for FDA approval is expected in late 2026. So we rebuilt 5 of history's greatest investors. We fed their published frameworks, their annual letters, their books and interviews into AI and built models of how each one evaluates a business. Then we put Eli Lilly in front of all 5. The scores surprised us. The highest score is a 7, the lowest is a 1, 6 points of separation on the same business, the same numbers, the same June 2026 moment. That spread is not noise. It is the most important signal the board can give you. Nothing you are about to hear is financial advice. These are models of publicly documented investment methods, not the investors themselves. The board convened in June 2026. All figures are from that moment, from verified public filings. The framework is the product, not the person. Before the board speaks, one number frames everything. Lilly trades at roughly 40 times its trailing earnings in June 2026. The pharmaceutical sector median sits near 16 times. Lilly is priced at 2.5 times what the market pays for a typical drug company. The question the board must answer: does the pipeline justify that premium? Novo Nordisk built Ozempic and Wegovy, the drugs that started the GLP-1 wave. Lilly's tirzepatide has shown 15 to 20% greater weight loss in head-to-head comparisons. They are not equal drugs. Retatrutide, if approved, is in a different category entirely. This is not a coin flip duopoly, but Novo is not standing still. Every investor in this room knows the pharma clock. Tirzepatide's core compound patent runs approximately through 2033 to 36. Trulicity, Lilly's older diabetes drug, is already losing exclusivity. The pipeline must replenish the moat before the clock runs out. That is the structural risk. Retatrutide is the answer if it gets approved. Philip Fisher, author of Common Stocks and Uncommon Profits. His scuttlebutt method asked one question above all others: does this company have products that will generate significantly increased sales for several more years? He built his framework on the idea that outstanding companies are worth holding for decades. He steps up first.
Fisher's model begins with the franchise question. GLP-1 is not a product cycle. It is a platform shift, the same category of structural change as the transistor or the internet, applied to metabolic disease. Tirzepatide is not the last drug in this class. Retatrutide is not the last either. Lilly has built the research infrastructure, the clinical trial machine, and the manufacturing capacity to own this platform for decades. That is what his model looks for. His second screen is management quality. Lilly's R&D investment, $11 billion per year, is not a cost line. It is a compounding asset. The pipeline depth is exceptional. Retatrutide, orforglipron, an oral GLP-1 that removes the injection barrier, donanemab in Alzheimer's, and a cardiovascular program building behind the obesity data. Fisher's model does not penalize a company for spending heavily on tomorrow if tomorrow's products are visible today. One flag in Fisher's framework: concentration risk. More than a third of revenue now runs through two drugs in a single class. A patent challenge, a manufacturing disruption, or a safety signal in Phase 3 could remove a significant piece of the franchise overnight. His model discounts for single-point concentration. He scores it a 7, outstanding franchise with one structural vulnerability.
A 7, Fisher sees a generational franchise and almost no ceiling. But one of the most rigorous minds in market history is about to tell you the floor is missing. Peter Lynch ran Fidelity's Magellan Fund to 29% annualized returns over 13 years, a record no one has matched at that scale. His rule was simple: understand the company in 60 seconds and never pay more for growth than the growth deserves. He makes the PEG ratio do more work than any other metric.
Lynch runs the PEG ratio first. 40 times trailing earnings divided by a 3-year earnings growth estimate of roughly 30 to 40% produces a PEG ratio of approximately 1 to 1.3. His target was 1. Anything below 1 is cheap. 1.3 is in his yellow zone, not red, not green. He would not walk away from a PEG of 1.3 on a business growing this fast, but he would also not call it a bargain. Then he separates the businesses inside the business. The GLP-1 franchise tirzepatide generating $16 billion and growing rapidly. He would buy happily at this multiple. The pipeline speculation, retatrutide priced in at 40 times before it is approved, he views with more caution. Lynch lived by a rule. The story must be simple enough to explain in 1 minute, and the price must match the story. The franchise story is simple. The pipeline story requires an FDA decision that has not happened. He also trusts switching costs. GLP-1 patients who achieve results stay on treatment. The refill moat is real, but Lynch applies the PEG test honestly. At 35 or 40 times earnings, the growth must be certain, not probable. He splits the franchise from the pipeline premium and lands in the middle. He scores it a 6. Outstanding growth company, slightly full price.
6. Lynch approves of the franchise but is watching the price. Next, the man who reads where capital is flowing before anyone else. Stanley Druckenmiller managed Soros's quantum fund and ran Duquesne Capital to consistent 30% returns. His edge is not stock picking. It is identifying the macro themes that attract enormous pools of capital and positioning ahead of them. He asks, where will the smart money flow for the next decade?
Druckenmiller's framework starts with the macro context. 1 in 3 adults globally is classified as overweight. The failure rate of traditional weight loss is above 90%. Tirzepatide and its successors represent the first pharmaceutical solution that works at scale. The capital following this theme, from biotech funds, from healthcare systems, from institutional allocators, is still in early innings. He sees obesity and metabolic disease as the dominant healthcare macro trade of this decade. His second question is asymmetry. At nearly $1 trillion of market cap, the absolute upside multiple is compressed. You will not get a 10 times return from here. But what Druckenmiller looks for is not just upside. It is the combination of a deep secular trend, a defensible competitive position, and a pipeline that continues to extend the franchise. Retatrutide filing in 2026 plus the oral GLP-1 in Phase 3 means the pipeline keeps feeding capital flows for at least 4 to 5 years. His hesitation, position sizing at this market cap limits the asymmetry. $1 trillion company doubling requires adding another trillion in value. That becomes a macro argument about the size of the obesity treatment market more than a company argument. He is a buyer, but he is aware of the ceiling. He scores it a 7, dominant secular position, slightly reduced upside from size.
7 again, 3 bulls, 20 of 21 possible. Is there a bear? 2 voices left, and they have both been here before on overpriced franchises. Before the bears speak, one picture. The blue bar, Lilly at roughly 40 times trailing earnings. The gray bar, the pharma sector median near 16. The gap between them is the question every remaining voice must answer. Has Lilly earned that premium, or is the market paying for a future that may not arrive on schedule? Warren Buffett, the greatest allocator in recorded history, his method is not about finding cheap stocks. It is about finding businesses with durable economic moats and buying them at a fair price. His most important rule: only invest in businesses you fully understand. The circle of competence is non-negotiable.
Buffett begins with the circle of competence question, and he has answered it publicly for pharma. He has consistently described pharmaceutical companies as outside his framework, not because they are bad businesses, but because predicting which drugs get approved, which patents hold, and which side effects emerge at scale requires scientific expertise he does not claim to have. The circle is the framework. Outside it, he does not invest, regardless of the headline numbers. Where he does engage, the analysis is rigorous. $45 billion in revenue at 81% gross margins would score well on his owner earnings test. The cash flow generation is extraordinary. But then the patent clock, tirzepatide exclusivity, runs roughly 7 to 10 years. After that, a biosimilar market emerges. For Buffett, a moat that expires in a known timeframe is not the kind of durable competitive advantage he requires. The moat must last indefinitely, not until 2036. The pipeline argument does not change this. Retatrutide is in phase 3, not approved. In Buffett's framework, you never pay for what might happen, you pay for what is. The 40 times earnings price pays for the pipeline. His model will not. He scores it a 2. Extraordinary cash flows from a business outside his circle at a price that assumes outcomes not yet in hand.
2. Buffett passes not on the business but on the complexity and the price. One voice left. He built the framework that defined what margin of safety means. Benjamin Graham, the security analysis author, the man who taught Buffett, his framework is the oldest and the strictest. A stock's price must offer a meaningful discount to its intrinsic value so that even if something goes wrong, the investor does not lose. The margin of safety is not a preference, it is the whole method.
Graham applies the margin of safety test first. 40 times trailing earnings against a pharma sector median of 16 times means Lilly is priced at a 150% premium to its peer group. There is no margin of safety at a 150% premium. There is only the assumption that the premium is deserved. Assumptions are not safety. They are bets. He then applies the asset test. Lilly's book value is essentially negative given the scale of debt and goodwill from acquisitions. Graham's model starts from assets, not from growth projections. If the growth stops, or if a trial fails, or if a patent is successfully challenged, there is no asset floor to protect the investor. He looks for floors. Lilly at 40 times has no floor he can calculate. The pipeline makes it worse in his view. Retatrutide's approval is probable but not certain. The market is already pricing it as certain. When certainty is priced in on an uncertain event, the risk is entirely asymmetric to the downside. If the drug is approved, the stock is correctly priced. If the drug is delayed or denied, the repricing is violent. Graham built his method to avoid exactly this trade. He scores it a 1. No margin of safety. He will wait for the floor.
1. Graham will not pay 2.5 times the sector median for a future that hasn't arrived, and now all 5 have spoken. Fisher 7, Lynch 6, Druckenmiller 7, Buffett 2, Graham 1. The composite is 4.6, the spread is 6 points, that spread is the story. On this company, on these numbers, 5 rigorous methods produce 5 different answers. Here is what the board is actually telling you. Fisher and Druckenmiller are not buying Eli Lilly, the drug company. They are buying a thesis that GLP-1 is the defining healthcare platform of the next 20 years and Lilly is the dominant position in it. Lynch agrees with the franchise but watches the peg. Buffett and Graham are not disputing that thesis. They are saying you have already paid for it. At 40 times earnings, if the thesis is right, you earn a fair return. If it is wrong, if retatrutide slips, if Novo catches up, if a patent challenge succeeds, the premium collapses. 28.3% average weight loss in phase 3. That number is not in dispute. What is in dispute is whether the stock already prices it in. Lilly expects to file for FDA approval in late 2026 with a potential decision in early 2027. Every quarter between now and that decision is a quarter where the market holds its breath. The bulls believe the data is too strong to deny. The bears note that drug approvals have surprised before. Beyond retatrutide, Lilly is developing orforglipron, an oral GLP-1 taken once daily. Injections reach roughly 5% of eligible patients globally. An oral pill changes that equation. If orforglipron reaches phase 3 success, the addressable market expands by an order of magnitude. This is the Fisher and Druckenmiller argument rendered in its starkest form. The pipeline is not one drug. It is a platform, and the platform keeps extending. Graham and Buffett see the clock. Tirzepatide's core patents run approximately to 2033 to 36. After that, biosimilars enter and the pricing power compresses. In pharma, exclusivity is the moat, and every moat has an expiration date stamped on it. At 40 times earnings, the market must believe either that the pipeline continuously replenishes the moat, or that the exclusivity period generates cash flows that justify today's price. That calculation requires precision that Graham refuses to trust. A 4.6 composite with a 6-point spread does not mean the stock is mediocre. It means the board cannot agree on the fundamental question: is the premium justified? That is not a failure of the method. It is the most useful thing the method can tell you. When 5 frameworks built over decades of real investing produce this spread on the same company, the uncertainty is real, not manufactured. The board judged the method, but methods outlive their authors. So here is the question only the living can answer. Of the investors who actually move billions today, how many are paying 40 times earnings for the company that might end obesity? We pulled the filings. We tracked 15 of the most followed living investors, the ones whose methods this board is built on. Not one of them holds Eli Lilly. 0 of 15. The most exciting growth story in pharma and the legends are all on the sidelines. And that absence is not a verdict on the science. It is a verdict on the price. At roughly 40 times earnings, Lilly trades above where long-term, value-disciplined allocators are willing to act. The growth is real, so is the premium. The legends are waiting for one of the two to break. And the crowd, Lilly pulls nearly 3 times the public attention of its average pharma peer, Novo, Pfizer, AstraZeneca, AbbVie, Amgen, elevated clearly, but the news volume is running below its own normal. Anticipation, not mania. The crowd is watching the pipeline, not yet stampeding it. So watch 3 things. Does Lilly file retatrutide with the FDA by year-end, and how fast? Does the oral drug orforglipron clear phase 3, and can the next generation bridge the patent cliff before it arrives? Those answers decide whether the premium was vision or fever. The board's verdict priced for the pipeline. This is not a dismissal of the franchise. It is an honest map of what 5 different methods see when they look at a nearly trillion-dollar company whose most important drug has not yet been approved. The bulls are buying the secular thesis. The bears are refusing to pay 150% premium for a future outcome. Both positions are internally consistent. The spread tells you the risk is real. Every episode on this board applies 5 methods to one real company, one real moment. The score is not a trade recommendation. It is a map of what the methods see. Which legend do you trust most on a company like Lilly? Leave your number below and we will see you for the next verdict.